Hello everyone, and welcome to Unit 11 of our educational series, Stock Investing 101. In this lesson, our intent is to help you understand the 10 most used financial ratios for stock investing. So, without any further ado, let's dive into each of the 10 financial ratios in more detail using George Burger Joint as an example. Debt-equity ratio. This ratio measures the amount of debt a company has in relation to its equity. For example, if George Burger Joint has $1 million in total liabilities and $2 million in total equity, then the debt-equity ratio would be 0.5, $1 million/$2 million. A high debt-equity ratio indicates that a company may have a higher financial risk due to a greater reliance on debt financing. Debt/capitalization ratio. This ratio measures the proportion of a company's capitalization funded by debt. For example, if George Burger Joint has $2 million in total debt and $8 million in total equity, then the debt/capitalization ratio would be 0.2, $2 million/$2 million plus $8 million. A high debt/capitalization ratio indicates that the company has high debt relative to its equity and may have higher financial risk. Cash conversion cycle. This ratio measures the amount of time it takes for a company to convert its inventory into cash. For example, if George Burger Joint takes an average of 30 days to sell its inventory, 20 days to collect payments from customers, and 10 days to pay its suppliers, then the cash conversion cycle would be 40 days, 30 days plus 20 days to 10 days. A lower cash conversion cycle indicates that a company is able to quickly convert its inventory into cash, which may indicate better efficiency in managing working capital. Return on capital employed, ROCE. This ratio measures the amount of net income a company generates as a percentage of its total capital employed, which includes both debt and equity. For example, if George Burger Joint has a net income of $1 million and total assets of $10 million, and current liabilities of $2 million, then the ROCE would be 12.5%, $1 million/$10 million to $2 million. A high ROCE indicates that a company is generating strong returns on its investments. P/B ratio. This ratio compares a company's market value to its book value. For example, if George Burger Joint has a market price per share of $10 and a book value per share of $5, then the P/B ratio would be 2, $10/$5. A low P/B ratio may indicate that a stock is undervalued. EV/EBITDA ratio. This ratio compares a company's enterprise value to its EBITDA. For example, if George Burger Joint has an enterprise value of $50 million and an EBITDA of $10 million, then the EV/EBITDA ratio would be 5, $50 million/$10 million. A low EV/EBITDA ratio may indicate that a company is undervalued. Asset turnover ratio. This ratio measures a company's efficiency in using its assets to generate revenue. For example, if George Burger Joint has revenue of $20 million and total assets of $10 million, then the asset turnover ratio would be 2, $20 million/$10 million. A high asset turnover ratio indicates that a company is efficient at generating revenue from its assets. Price/FCF ratio. This ratio compares a company's market value to its free cash flow. For example, if George Burger Joint has a market price per share of $20 and a free cash flow per share of $5, then the price/FCF ratio would be 4, $20/$5. A low price/FCF ratio may indicate that a stock is undervalued. Interest coverage ratio. This ratio measures a company's ability to cover its interest expenses with its earnings. Let's say George Burger Joint's EBIT is $1 million and their interest expense is $100,000. Their interest coverage ratio would be 10, indicating that they can cover their interest payments 10 times over with their earnings. Dividend payout ratio. This ratio measures the percentage of earnings that a company pays out as dividends to its shareholders. For George Burger Joint, if their total dividends are $50,000 and their net income is $200,000, their dividend payout ratio would be 25%. This means that George Burger Joint pays out a quarter of its earnings as dividends to shareholders, while retaining the rest to reinvest in the business. In this lesson, the focus is on helping individuals understand the most commonly used financial ratios for stock investing. These ratios provide valuable insights into a company's financial health and performance, and can help investors make informed decisions about whether to invest in a particular stock or not. The lesson covers 10 financial ratios in detail and uses George Burger Joint as an example to illustrate how each ratio works. Let's have the recap of what we studied so far. Debt-equity ratio measures the amount of debt a company has in relation to its equity. Debt/capitalization ratio measures the proportion of a company's capitalization funded by debt. Cash conversion cycle measures the amount of time it takes for a company to convert its inventory into cash. Return on capital employed (ROCE) measures the amount of net income a company generates as a percentage of its total capital employed. P/B ratio compares a company's market value to its book value. EV/EBITDA ratio compares a company's enterprise value to its EBITDA. Asset turnover ratio measures a company's efficiency in using its assets to generate revenue. Price/FCF ratio compares a company's market value to its free cash flow. Interest coverage ratio measures a company's ability to cover its interest expenses with its earnings. Dividend payout ratio measures the percentage of earnings that a company pays out as dividends to its shareholders. Now that we have covered the 10 most commonly used financial ratios for stock investing, it is important to note that these ratios should not be used in isolation when making investment decisions. It is crucial to also consider other factors such as the company's industry, management team, competitive landscape, and overall economic conditions. Investors should also keep in mind that financial ratios are not static and can change over time, especially as a company's financial situation changes. As such, it is important to continuously monitor a company's financial ratios to stay updated on any changes that may impact investment decisions. By understanding these ratios, investors can gain a better understanding of a company's financial position, risk profile, and ability to generate profits. This knowledge can help investors make more informed investment decisions and potentially achieve better returns on their investments. In the upcoming chapters of this series, we'll dive deep into various investment concepts. We hope that by the end of this series, you'll have a good understanding of stock investing and be on your way to becoming a successful investor. We would love to hear your thoughts on the financial ratio and let us know which ratio you use most of the time. If you found this lesson helpful, please give it a thumbs up and subscribe to our channel for more valuable insights on investing.